So let's dive in to your 7-year creating wealth plan. So first of all, we take our pro forma. One of the best decisions I ever made 22 years ago is benchmarking my data, standardizing my data. And you've got to do that too as an investor so that you don't have to be a detective on every deal. Now, how did I do that? I used the property tracker software. I started using it back in 2004, and I liked it so much I bought the company. I suggest you use it. When I bought the company, I made it free. So just go to propertytracker.com, get a free account. You can do these yourself. You can play with the numbers. You can change the numbers, all kinds of stuff. It's really easy. This is the one thing that will really, really make you a very good investor, is running the numbers and using the pro forma. So the most commonly used pro forma is the one we're going to use today, is the 1-year projection. And it always has assumptions. So these are the assumptions we're using throughout the 7-year plan that we're going to be discussing today. And these assumptions are very conservative. Now, there's no shortage of sleazy operators in the world. In my business, there's a lot of sleazy, unethical players. And what do? Well, they don't use conservative assumptions. They assume the property will be occupied and the tenant will be paying rent on time 100% of the time. That's just not the way it works in real life, folks. You're going to have vacancies, whether they be physical vacancies or economic vacancies. What's the difference? Well, a physical vacancy is when the house is vacant, okay? But an economic vacancy is when the house is occupied, but they're not paying rent, okay? So either one of those is not good. So we assume that the property will be vacant 1 month every year. So that's about an 8% vacancy rate. We assume moderate appreciation of about 6%. Now, some years, like last year, the market was terrible. Okay, last year you only had, depending on what survey you're looking at, 1 to 2% appreciation. But during the COVID era, you would have seen in, a year and a half, 2 years, depends on what survey you look at always, because they all calculate it a little differently. You would have seen anywhere between 49 and 55% appreciation. Okay, of course, this also depends what markets. I'm just talking broad, national, generic numbers here. All real estate is local, always know that. And then what will the inflation rate be? We've added the inflation assumption that you can see right here of 3% to our performance. Why did we do that? Well, there used to be no inflation assumption. And we added that because we also added my trademark strategy into the actual pro forma so you can see the math. It's called, of course, inflation-induced debt destruction, my trademark strategy that I've been teaching for 22 years. That's now in the pro forma. You can see the math. You can see how much that is increasing your wealth every single month. We assume here on this example property, $86 a month in property management fees. Now, this example we're going to do is simplified, okay? There's no way we could go into every number, change every number. It's a simplified example. Just understand that from the beginning. And real life may well be different. So what I'm going to do is we're just going to take the totality of it. We're going to show you very, 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 very good return on investment here. But then we're just going to cut it in half. And we're going to say, what if it only goes half as well as we expect? And it's still going to be pretty good. You're going to like it either way. And the reason income property is the most historically proven asset class in the entire world is that it's a multi-dimensional asset class with very special characteristics. Most investments, the whole strategy, buy low, sell high. Precious metals, non-dividend paying stocks, cryptocurrencies, right? And I know there's creative things you can do with things, okay? But I'm just doing it the way most people do it, okay? Buy low, sell high. Dividend paying stock, buy low, sell high, get some dividends in between. Income property, you make money at least 6 ways, okay? It can't be matched. It's a special asset class. And that's why it's the most historically proven asset class in the entire world. We're going to assume for all of the years until year 7 that the maintenance percentage, this is a brand new home, by the way, brand new single family home in one of our markets, that's what we're showing you, is 2%. Okay, 2% of the income is dedicated toward maintenance. Now, let's get into it. So here is the first year pro forma. This is the acquisition year. This is the year we buy the property. Now, I'm going to blow these up for you by cutting the pro forma page in half and showing you a screenshot of both halves of the page so you can see the numbers. So here's a property that's a brand new single family home that makes a good rental property. It's almost 1,800 square feet. It's priced at $263,990 with 25% down. You're going to need, with closing cost, a little over $75,000 to acquire this property. The projected rent is $1,800. Now, that gives you an RV ratio or a rent to value ratio, something we also recently added to the property tracker pro forma of 0.7. And by and large, ideally we want to get 1%, and in some markets you can even get better than 1%, but you can't do that anymore. Look, as Yogi Berra said, the future ain't what it used to be. Well, I'll modify his saying and say the present ain't what it used to be. You know, prices have gone way up, and rents take about 3 years to catch up. So we are still in that cycle where the rents are catching up to the prices. And really, the past couple of years, the rents have even been pushed further behind because of the collapse in the multifamily apartment market, which has been very tough. I mean, people have lost fortunes in the multifamily market. Syndicators have ripped people off. They have overpromised and underdelivered. It's terrible. Okay, it's really bad. And that market is starting to heal pretty nicely. So give it a little time and it's going to be healed. But why did that affect us? As single family home investors, I like single family homes. It's my favorite asset class. Well, the reason it affected us is because they have been making deals and they have been offering incentives that have been sucking some of our renters out of the single family market into these apartments. They would rather rent a single family home, but the deals are just too good to ignore. So that has forced the rents to be a little soft the past couple of years. But folks, that's all changing. And with our new Fed chair, we are moving into an easy money market. You know, whenever the money is easy, meaning lower rates, more availability of financing, look at the MCAI, the Mortgage Credit Availability Index for that, because there's really two factors in easy money, right? And there's also QE, right, which makes the money flow easier and the borrowing easier and all of that stuff. So when we're in that type of market, asset prices almost always go up. I mean, I don't want to say always because someone's probably going to say, like my friend George Gammon, he would pick at that, right? He'd say, well, Jason, there was a recession in 1946 and, you know, it didn't happen then. Okay, George. You know, it's only 70 some odd years later or whatever, right? But so I never want to say always, right? I don't want to be that direct about it. But, you know, that's the trend, right? Easy money causes asset prices to increase. Now, for simplicity's sake in this example, we're looking at interest-only fixed rate loan. We're going to just do a very round number and say it's 6%, you know, subject to qualifying. I'm not saying you can get that today. We're just making a simplified example here, okay? It's a simplified example. Just understand that. We can't really like agonize over every number because we got to look at it over 7 years. And we're going to cut it in half at the end. Okay, so it's going to be a throwaway. If you think some of the assumptions aren't conservative enough, which I think they are, just cut them in half. Okay, you'll still be happy. Here we go. $1,800 a month rent. We've got our vacancy losses and giving us operating income of about $1,650. Okay, so here's the second half, the bottom half of the pro forma. We've got our expenses here, taxes, insurance, HOA fees, all of that good stuff. And here, this property is projected to have a $288 per month positive cash flow, almost $3,500 per year. And here is the new thing we've added, inflation-induced debt destruction. And this is showing you that inflation is essentially paying off almost $6,000 per year on this mortgage. Remember, how do we calculate that? 3% inflation would make that almost $6,000. So it's $5,940. And if you divide that by 12, that's $495 per month. So inflation is this hidden wealth creator that is making people richer and richer and richer because you borrow the dollars today at today's dollar value, and inflation debases those dollars so that you get to pay them back, or really your tenant pays them back for you. It's a leveraged buyout. Remember, it's an LBO, just like the Wall Street tycoons use. Same idea here. They pay the debt back at a cheaper rate after inflation has debased the value of it. Now, this math is actually not as good as real life. Why do I say that? Because inflation-induced debt destruction debases not one, but two things. It debases the overall mortgage balance, which is what we're calculating here, but it also debases the monthly payment on the mortgage. And I've shared with you over the years the example of my mother buying her first house in West Los Angeles, agonizing over how the payment on that house would be $416 per month. I remember as a child overhearing her conversations with adults about, how am I going to make the payment? It's so high. I don't think I can afford it. Yada, 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 right? Okay, so I heard this conversation many times, but in reality, what happened is after a few years, 3, 4, 5 years of inflation-induced debt destruction that she didn't even know was helping her, that payment felt lighter and lighter and easier because $416 was more burdensome at the beginning and less burdensome later because inflation had debased it. So we're only debasing the balance, not the payment here. So it's actually, this example is actually better than we're showing it to be. All right, so the return on investment, all things considered, the first year is 26% annually, but if you add in the $495 per month or $59.40 per year for inflation-induced debt destruction, we've now added that. We're calling it IIDD for short because I know it's a mouthful. That is now 34% annually. And I know you're thinking, some of you that don't get real estate, that don't understand income property is the most historically proven wealth creator in the entire world. It's the most tax-favored asset class in America. Nothing beats it. You think, oh my God, those returns are just too high. It's too good to be true. No, it's not. Okay? And if you think it's too good to be true, just cut the numbers in half. That's what I'm going to do for you at the end of this. Okay? Just assume it's only half as good as we're talking about. But remember, it's a unique, multi-dimensional asset class. And that's why you can earn those kinds of returns, because 6 things are driving them. Not one thing, not 2 things, not 3, 4, 5, 6 things. 6 things are driving those returns. And that's why it is so phenomenal. I mean, you know, you've listened to my shows maybe where I talk, and I haven't talked about this enough lately, about the ultimate investing equation. And the ultimate investing equation, go back and listen to those episodes, please. I mean, I've been teaching that for, I don't know, easily 14, well, no longer than that, probably since 2008, okay, when I started teaching the ultimate investing equation. And that shows you how unique and multidimensional this asset class is.